Imagine waking up one day to find that everything you've worked for is crumbling around you.
That's bad. That's trouble.
Your savings, investments, and the very foundation of the economy are disintegrating before your eyes.
Boys, what have you done?
This isn't a scene from a dystopian movie. It's a very real possibility in 2024. Today, we're diving deep into the ticking time bombs of our current economic landscape, bubbles that could burst and bring the global economy to its knees. We're going to explore 7 critical bubbles, silent threats that could lead to a catastrophic economic collapse. First up, the student loan debt bubble. In the United States alone, student loan debt has surpassed a staggering $1.7 trillion. But how did we get here? The origins of this bubble trace back to the 1980s when higher education became synonymous with the American dream. Colleges saw an influx of students, and in response, tuition fees soared. The federal government's willingness to lend money to almost anyone seeking higher education fueled this growth, creating a vicious cycle of borrowing and rising costs. Why does this bubble exist? Simply put, higher education has been marketed as an essential pathway to success, leading students to take on massive debt with the hope of better job prospects. But what happens when these graduates can't find jobs that pay enough to cover their loans? If this bubble bursts, it won't just affect students and graduates. It will ripple through the economy, reducing consumer spending, increasing default rates, and potentially triggering a broader financial crisis. The trigger for this bubble could be a sudden change in government policy on student loan forgiveness or repayment terms. Additionally, a significant economic downturn could lead to higher unemployment among graduates, increasing default rates and destabilizing the financial system. Next, let's examine the healthcare cost bubble. The U.S. spends more on healthcare than any other developed nation, yet millions remain uninsured or underinsured. Since the mid-20th century, healthcare costs have been on a relentless rise. Advances in medical technology, an aging population, and a profit-driven healthcare system have all contributed to this surge. This bubble exists because of a fundamental misalignment in the healthcare system. Costs keep rising while wages remain stagnant, leaving many unable to afford necessary care. Insurance companies, pharmaceutical giants, and healthcare providers prioritize profits over patients, exacerbating the problem. A collapse in this sector would be devastating. It could lead to a severe public health crisis, overwhelm hospitals, and cause a surge in medical bankruptcies, dragging the economy down with it. The trigger for this bubble could be a significant policy change, such as the implementation of universal health care or major reforms that disrupt the existing profit-driven model. Another trigger could be a major public health crisis that exposes the inadequacies of the current system. The unfunded pensions bubble is another looming threat. Public pensions are underfunded by trillions of dollars, and as baby boomers retire, this problem is becoming more acute. This bubble started decades ago when governments and corporations promised generous pensions without adequately funding them. Over time, demographic shifts and poor investment returns have widened the gap. Pensions are underfunded because of optimistic assumptions about investment returns, longer life expectancies, and political reluctance to increase contributions or reduce benefits. The result is a looming shortfall. When this bubble bursts, retirees may find themselves without the support they were promised. This could lead to widespread financial insecurity among the elderly, reduced consumer spending, and increased pressure on social services and taxpayers. The trigger for this bubble could be a significant economic downturn that reduces the value of pension fund investments, or political decisions to cut benefits or delay payouts. Such triggers could lead to widespread panic among retirees and investors alike. The federal debt bubble is perhaps the most talked about, yet it continues to grow unabated. The U.S. federal debt has surpassed $30 trillion and is climbing rapidly. This bubble started with decades of deficit spending, driven by wars, tax cuts, and expansive social programs. Each administration has contributed to the mounting debt, often prioritizing short-term gains over long-term stability. The federal debt bubble exists because of political unwillingness to address the root causes of the deficit. Borrowing has become the norm, and with low interest rates, the perceived urgency to tackle the debt has diminished. If this bubble bursts, the consequences could be severe. Rising interest rates could make the debt unmanageable, leading to a default or drastic spending cuts. This could trigger a global financial crisis, given the interconnected nature of the world economy. The trigger for this bubble could be a sudden spike in interest rates, either due to inflationary pressures or changes in Federal Reserve policy. Such a spike would increase the cost of servicing the debt, potentially leading to a fiscal crisis. High interest rates are another significant bubble. After years of historically low rates, central banks are starting to increase them to combat inflation. This bubble formed as central banks kept rates low to stimulate the economy post-2008 financial crisis. Cheap borrowing costs led to a surge in debt across all sectors: households, corporations, and governments. The existence of this bubble is due to the prolonged period of low rates, which encouraged excessive borrowing and risk-taking. Now, with rates rising, the cost of servicing this debt is increasing, putting pressure on borrowers. If this bubble bursts, it could lead to widespread financial distress. Higher borrowing costs could trigger defaults in mortgages, corporate debt, and even sovereign debt, leading to a cascading effect on the economy. The trigger for this bubble could be a series of rapid rate hikes by central banks in response to persistent inflation. Such actions could lead to a sudden increase in borrowing costs, overwhelming borrowers, and causing widespread defaults. Inflation is the silent thief eroding purchasing power. In recent years, inflation has surged to levels not seen in decades. The inflation bubble started with supply chain disruptions, labor shortages, and massive fiscal stimulus during the COVID-19 pandemic. Pent-up demand collided with constrained supply, driving prices up. This bubble exists because of a combination of factors: loose monetary policy, supply chain issues, and geopolitical tensions. Central banks are now trying to rein it in, but the measures could have unintended consequences. If this bubble bursts, we could see a period of stagflation, high inflation coupled with low economic growth. This would erode consumer confidence and reduce spending, leading to a prolonged economic downturn. The trigger for this bubble could be persistent supply chain disruptions or geopolitical events that drive prices even higher. Additionally, central bank policies that fail to control inflation could lead to runaway inflation, eroding consumer and business confidence. Finally, the artificial stimulus of the economy by the federal government is a bubble that has been inflating for years. Trillions of dollars have been pumped into the economy to stave off recessions and support growth. This bubble began with the 2008 financial crisis and expanded dramatically during the COVID-19 pandemic. Governments and central banks around the world injected massive amounts of liquidity into the economy. The existence of this bubble is due to the reliance on artificial stimulus to maintain economic growth. This creates a dependency on government intervention, masking underlying economic weaknesses. If this bubble bursts, the withdrawal of government support could lead to a sharp economic downturn. Stock markets could crash, businesses could fail, and unemployment could rise, leading to a severe recession or even depression. The trigger for this bubble could be a significant reduction in government spending or a tightening of monetary policy by central banks. If governments and central banks decide to scale back stimulus measures too quickly, it could expose the economy's underlying fragility, leading to a severe downturn. These bubbles are interconnected, and the bursting of one could trigger a chain reaction, leading to a global economic catastrophe. As we move through 2024, it's crucial to stay informed and prepared for these potential shocks. Will we learn from history, or are we doomed to repeat it? Don't forget to subscribe to our channel and hit the notification bell to stay updated on the latest economic insights. Share this video with your friends and family so they too can understand the risks we face and how to prepare for what's coming.